Hi everyone. I'd like to show you what a complete answer looks like for Assignment 1, Module 1. So I prepared a set of financials, income statement, statement of retained earnings, and balance sheet, as well as calculated the return on assets for a particular company, DR Painting. It may or may not look like the example I've given in assignment number 1. But let's go over the formatting, and I'll give you a few helpful hints to get you through the preparation of these financial statements and the calculation of return on assets. So, we always start off with the income statement, and we will always want to title our statements with the name of the company, the name of the statement, and the period that it covers. For an income statement and a statement of retained earnings, the period of time that it covers is for the year ended December 31st, 2021. But for a balance sheet, it's a snapshot in time. So the period of time, there's only one day that we show the last day of the accounting period, because it's a snapshot of our financial position, assets, liabilities, equity, as of a particular day. On the income statement, we only list the revenues and expenses of the business. So we're going to start off with revenues, and be sure to title it with a colon and then list your revenues. Okay, list your revenues out here on the right-hand margin. And then we'll go down to the expenses. So title it with expenses and a colon, and list your expenses in order of magnitude, with the largest being on the top, going down to the smallest. Be sure to indent your expenses to a middle column so that you can list out your expenses and put your total expenses out here on the right-hand margin. So we want to total up our expenses and put the total of expenses right here. And now we subtract our expenses from our revenues, and we come up with the net income. Now, the reason why we have to do an income statement first is because we need that net income to prepare the next financial statement, which is the statement of retained earnings. Right, the statement of retained earnings. And we start off with the retained earnings at the beginning of the year. And in my particular example, this is the first year of operations, so we have 0 in retained earnings at the beginning of the year. To that 0 retained earnings, we add our earnings of this year, which is our net income, come to a subtotal, and subtract our dividends from that subtotal to arrive at our retained earnings at the end of the year. Now, the retained earnings at the end of the year is the retained earnings that we will use down here in our balance sheet. All right. After having prepared the statement of retained earnings, we're now ready to do the balance sheet. So we start off with our assets. So be sure to title it assets with a colon, and list your assets, always starting with cash, and list them in the order of liquidity, with cash being the most liquid, accounts receivable, etc., being less liquid than cash. Total up your assets and put the total out here with an underline if you can, indicating that's the end of the calculation. Now we're going to go on to our liabilities section. So title it up with a colon, liabilities. And in my particular situation, I only have one liability, accounts payable. So I don't need to total it up. I'll just put the account balance of the liability right here. Now we're on to the next section, stockholders' equity. So title it stockholders' equity. And it's tradition to start with common stock first, and its account balance, and the retained earnings balance. And remember, we're getting this balance from our retained earnings statement. Add those two stockholders' equity accounts up together and put the subtotal here as, the total there as total stockholders' equity. And now you're ready to do your last calculation, which is adding up your total liabilities plus your total stockholders' equity, and that equals your total liabilities and stockholders' equity, and I should underline that, indicating that's the end of the calculation. Now, I asked you to calculate the return on the assets using the financial statements and also the beginning balance of total assets that I gave to you in the problem. So you know that the calculation of return on assets is net income divided by average total assets, and average total assets equals the beginning of the year total assets, which we can't see from these financial statements, plus the end of the year total assets, which we can see from this financial statement. There's my end of the year total assets. All right, so average total assets, beginning of the year total assets plus end of the year total assets added together divided by 2. That's what average total assets means. All right, in my situation, my net income is $5,300 right here. And I'm going to divide it by the average total assets for DR Painting. Now, because DR Painting, this is its first year of operations, it has 0 in total assets at the beginning of the year, but it does have $30,500 in total assets as shown on the balance sheet right here. So add those two together, the beginning of the year total assets and the end of the year total assets, and divide that result by 2. Now you're ready to do the calculation for return on assets, net income divided by average total assets. In DR Painting's situation, their ROA is 34.8%. Now, if a competitor's ROA were 10%, DR Painting's ROA shows that DR Painting would be producing more profit per every dollar of assets than the competitor, right? Because the ROA for DR Painting is 34.8%, that means that for every dollar invested in assets, DR Painting is generating 34.8 cents of profit on those assets for every dollar of assets. I hope this helps.